Hey guys, Stefan here. Today we're doing a video about why I believe the RBA is short-sighted on Bitcoin. So this has come up out of a speech called Cryptocurrencies and Distributed Ledger Technology. It's by Tony Richards, Head of Payments Policy Department at the Reserve Bank of Australia. And this was at a talk last week at the Australian Business Economists. So what's going on here? So he starts off with a quick primer on Bitcoin. And one of the first points he gets to here is about crypto assets, rather than it's not necessarily being used, generally as a currency. And sure, it's early days. So the comment I'd offer here is that we should consider William Stanley Jevons's work, and he's an economist from the 1800s, and he makes a point here about how it's there's the, let me see if I can find that section. Yeah, here it is. So the use of esteemed articles as a store or medium for conveying value may in some cases precede their employment as currency. So you can see here, so he's sort of saying, historically speaking, the generally esteemed substance as gold in that time, in that example, was firstly a commodity valuable for ornamental purposes, then stored wealth, then medium of exchange, and lastly measure of value, or what we would colloquially call unit of account. So it's an appreciation that these things are going to start as a collectible, and it's just now moving into that stage of being seen like a store of value. So that's the comment I would offer on that point. Then later we get into a few things around energy usage of the Bitcoin system. So you can see here, it's that, which we've commonly seen people say about, oh, it's equivalent to the entire energy use of countries like Switzerland and so on. I think it's not quite that much. Some of those figures have been debunked. However, I would say that, yes, it is true, Bitcoin may someday, if it's successful, may someday come to be a huge portion of global energy use. But here's the rub, it'll be worth it. The reason being, the amount of people spending time making money should be less compared to other things, because it stops us having to barter. So the point here is, we use money as like it's a special thing that we use that enables us to make gains elsewhere, because we don't have to spend as much time bartering and so on, back and forward. And if you were to consider all of the amount of time that the world's governments spend creating money, managing their money, all of the financial architecture and infrastructure, that too would add up to a lot of energy cost. So ultimately, society should choose the money that uses the least, and the way that we can do that is by choosing the best money. And that's where we get into things like monetary attributes, like which one is the most scarce money, which one has the best stock to flow ratio over the long run. So that's really the point that we should understand there. So the next part here is talking about, let me just find the section. Yeah, so it's just a section just below that, an energy part, where he's saying conventional national currencies get their value in part from the fact that legislation says that they are legal tender. So I'd agree with that. So that is part of the answer right now. And obviously we've seen in the world, there are examples where governments trash their currency and people don't want to hold their value in that. So if you look at Venezuela, or if you look at Iran as recent examples, and in the past you've seen other examples like Zimbabwe and Argentina, so on. Really, the point is not that that something has to have intrinsic value, like he's suggesting here, saying, however, Bitcoin has no intrinsic value. It's really more that which one will be the best money, and which one will other people perceive to store their value best, through time and space. So there's a bit more at play there. And then, so he gets into a little bit further about, Bitcoin's history and its price. So you can see here on the graph, it started at 0 and has peaked around 20,000 in November or December last year. and is currently sitting around 6,000 right now. He talks about some of the early adopter groups, and so he's talking about, so here he's kind of got three main groups: those who are attracted by the innovative design and technology, and these could be, you know, more technical programmer, technologist types. And then here, the second is the example of people who want anonymity in payments, so things like, you know, darknet markets, Silk Road, that sort of thing. And then lastly, those who we might call crypto libertarians. So, and I think in a sense that is what's referring to me, people like me, right? People who don't agree with the current setup of the financial system and think that central banks enable credit expansion, which leads to what's called a boom and bust cycle, also known as the Austrian trade theory of the trade cycle, or Austrian business cycle theory. Although I would say the characterization is slightly off here. So he's saying yes. So some of them assert that the quantitative easings undertaken by major central banks in the wake of global have somehow debauched the value of traditional national currencies. And then so he's saying, well, look, after 10 years after this quantitative easings, inflation in the major economies is still quite subdued. But that's not the full argument, really. In my view, the view is central banking as an intervention and other government interventions create what we call fractional reserve banking. That creates a credit expansion beyond the amount of people who have voluntarily given up some, you know, consumption today to save, and in doing so, it sets this sort of train in motion of what's called the boom and bust cycle. And also, not just that, you've also got to consider that, okay, inflation in the major economies might seem subdued. However, your purchasing power still has gone down by more than if you had held, say, an actually stable currency, a stable supply currency, if that makes sense. If the supply of Australian dollars or US dollars had stayed the same, your purchasing power would be much, much higher. So anyway, that's a little bit of the history of it, but I guess it is good to understand the actual basis on which, you know, the crypto libertarians or the crypto Austrians would really critique central banking. I might do another video on that in future to go a little bit further in depth on that. And then we get into, let me find the section. Yep, so here we're getting into a discussion around the payment as a payment network. So here he's talking about the confirmed transactions. So, okay, here's a graph of confirmed Bitcoin transactions, a peak of 4.5 transactions per second. And I can understand why he's approaching it from this angle, because, you know, he's part of the payments, you know, area within RBA. But I think we've got to really understand what Bitcoin is. Bitcoin is more like a settlement network rather than a consumer payments network, meaning large banks will do on-chain transactions and small transactions will occur on layers above that. So even that 4.5 transactions per second, even that figure isn't really right in a sense, because what's happening now is we're seeing transaction batching. So it might be one transaction from a Bitcoin exchange paying out to 10 different people, right? So it's just not that not that easy. It's not that simple. So then he's using this example to say, well, look, this episode points to the scalability and governance problems of the Bitcoin system. So even here, I would suggest that really we've got to understand the ecosystem of Bitcoin, and what's happened over the last year or so was that a lot of exchanges and hosted wallet services who do a lot of the Bitcoin transactions were not being, let's call it, stewards or custodians of the Bitcoin system. So they were doing things like not batching their transactions, not using SegWit, not consolidating change. And in doing so, that's part of what pushed that fee so high. But then what happened is the adjustment happened. Because the fees went so high, then they started looking into, okay, now I'm going to try and learn how to batch my payments, and do all these other things that enable them to make cheaper on-chain transactions. And then the next factor to think about is obviously Lightning Network. So with Lightning Network, you can see here, so this is just an example. We've got 2,000 nodes, and remember that's visible nodes. Some nodes are hidden, and then for each of these channels, the transactions is something like 500 per second. So we're talking like millions of transactions per second that are possible in a if Lightning Network really develops out the way we anticipate that it will. And then another example is this concept of channel factories. Now this is still coming. It's obviously not implemented yet, but they help scale Lightning Network as well. So here we've got an answer by David Harding, who's a well-known Bitcoin expert and helps document some of the technical documentation around Bitcoin. And so he's basically suggesting channel factories are these payment channels that can be used to create more payment channels. And so the concept is that multiple people would get together to create a payment channel deposit transaction. And what that does is it really dramatically, so once you get enough users, it really dramatically saves the amount of basically Bitcoin on-chain space required to do a transaction. And remember, the transaction fee is driven by block weight of your transaction, which is this VBytes component here. So you can see here the savings, 90% if you get 10 users who are setting up multiple channels. So in a way, what it is like it's aggregating the setup of channels on Lightning Network to set up these payment channels such that we can do many transactions at a tiny fraction of the fee. So again, there's some of the points that we have to consider. What else have I got? Okay. So next part is he's talking about, I think he's got a volatility point here. Okay, so he's basically saying, look guys, the daily price change of AUD USD versus BTC USD is, much lower volatility in Australian dollars. But again, this is considered from the, right now. So obviously right now, Bitcoin is this tiny little drop in the bucket compared to the global global quantity of money. Yeah, so Bitcoin's market cap today is probably around 100 billion or so, whereas the global broad money would be M3 broad money would be something like 90 trillion US dollars. So we're talking about this tiny little drop in the ocean. Obviously, once Bitcoin gets bigger, then the volatility will subside. So that's really one way to think about it. The other thing to think about is think in the long run. So you can see here on these CoinDance statistics, so current day price 6,300 US, and if you held for 1 year, you're up, your gain 158%. If you held for 2 years, 847. If you held for 5 years, 6,591%. So these are some examples where really people just have to lower their time preference and think on a longer time horizon. And that is a big part of why Bitcoin will be a better store of value in the long run. So that's one point. The other point is just to consider, it's not saying that everyone should just be going all in Bitcoin, right? They should just consider Bitcoin as a part of their broader portfolio. And we're starting to now see more and more research coming out talking about this concept. So here's an example by Grayscale, A New Frontier. And in this, they're talking about this concept of the efficient frontier, which is a concept from investing. And if you were to incorporate digital assets such as Bitcoin, that you can get basically more return for the same level of risk. Yeah. So this concept here is talking about, okay, well, what happens if instead of just doing a standard 60-40 stocks and bonds portfolio, we did something like 60-40, but added a small percentage, 1 to 5% of Bitcoin? Well, here's what would have happened. You would have gotten more return and the Sharpe ratio would have been improved. Now, if you understand the Sharpe ratio, that is a concept from finance which basically talks about how well is the investor being compensated for the additional risk that they are taking on. And in this example, where if it's got a very high Sharpe ratio, that means, yeah, you're getting great value for money in that sense. You're getting better return for very lower risk. And that's that's how you can use Sharpe ratio to compare different assets, right? So in this example, it's talking about how, we're seeing even just adding a 5% allocation, massively improved the risk-adjusted returns. So that's another example there. What else have we got? So let's move on. There was a point here around merchants. Let me just find that. Okay, here it is. I think it is. So here he was saying, so Tony's giving this example of how he managed to find a Sydney cafe that accepts Bitcoin for coffee. Now, there's a few things to understand here. When Bitcoin was just getting started, and so Bitcoin obviously first got started in 2009, but in terms of having a price and being used in merchants and so on, probably around 2012, 2013 was when that really started to pick up. At that time, the Bitcoin community, in my view, was putting the cart before the horse. They were trying to get merchant adoption before the merchants truly wanted to hold Bitcoin. So consequently, what were those merchants doing? They were basically accepting Bitcoin, but immediately selling it on an exchange to get back fiat money. Because remember, their costs are denominated in fiat money. So this is a point where, coming back to that discussion we were talking about earlier with the William Stanley Jevons point, it's that money's going to evolve through stages, and we're trying to jump straight to that globally medium of exchange back in the 2013 days is probably a little ahead of its time. So now, to be fair, we are starting to see more solutions that enable merchant adoption, but I still think it's not quite there yet. And remember, what Bitcoiners would want is merchants to hold the Bitcoin, and the reason they would want to do that, they would want to do that if it was a good store of value. And in that journey from starting as a collectible, moving through to the global unit of account concept, it's on the way to get there. It's going to start as a collectible and it's going to go to store of value and then medium of exchange. So we are currently just transitioning from that collectible stage to the store of value stage. So that's the point to consider there. The other component is, where was it? Authorization. Here it is. So he's saying, for example, while authorization of a debit or credit card transaction is close to immediate, Bitcoin users are typically advised to wait for the creation of about 6 additional blocks, i.e. 60 minutes, before relying on the transactions as being final. Now, we are starting to see examples of Lightning Network, which can be done without sort of confirmation, if that makes sense, because these payments are what you might think of as sort of cryptographically proven. So you actually can take a zero confirmation transaction on using the Lightning Network, which we're starting to see. And here's an example from a video that went pretty viral, about 2,000 retweets. Let's see.
Cafe at Brisbane International Airport in Australia. I'm just going to buy a coffee with Lightning Network. So the fee is about 43,000 satoshis. So I've got the Eclair wallet here, which is a Lightning wallet. So I'll just scan this payment request. Click pay. So the payment's been sent and the payment's been received. It's as easy as that. So you can now pay for coffee with Bitcoin using the Lightning Network.
So there you have an example. So you can see there that it's very, very fast. It was basically faster than even a tap and pay. So that's the possibility that's coming, but it's going to take some time to get there. It's a long run thing. We can't just sort of wake up and expect it all, this new money to be formed and all the infrastructure around this new money to be perfect from the get-go. That's just not how this is going to work, right? One other example is just, you can see from this CNBC article, is there are well-known investment managers like El Arian who are basically talking about how it's, they're starting to now see Bitcoin, as a commodity-like asset and mainly as a store of value. So that's an example of how this is evolving over time, and it would be folly to not sort of have an appreciation for that. So what else? The other point is just around the stock to flow ratio. So let me just find a good link for that one. So here was a report put out. I can't remember the exact name of this report. I'll find the link and put it in the description. But basically what this is talking about is how stock to flow ratio is superior with Bitcoin to anything else over time. So what you'll see, so what are we talking about here? Stock to flow ratio is, think of it as the total stock of something that exists versus the new amount, that is new flow, that's coming in that year. So in currencies like the Australian dollar and the US dollar, it's something like 5% or a bit more. It can be a bit more, like long run average. With gold, it's something like 2% per year. With Bitcoin, it's gonna, as we hit new halvings, it will decrease, and it will, so at the next halving, it'll be something like 2%. And then the next halving, it'll be even less, and then less and less and less. And so that's how you can see here on this chart that although gold has a sort of stable 2% inflation rate, let's say, or something, roughly, Bitcoin is going to become even more scarce. So which of these do you think would be a better long-term store of value? So that's the concept with that. What else have we got here? So we've got a discussion around, however, I think the evidence to date is that trustless blockchain solutions are unlikely to be adopted. Rather than new systems are more likely to be permission shared ledgers. So in that sense, actually, I can probably agree with some parts of that actually some of this whole blockchain, not Bitcoin sort of stuff, probably not really gonna be relevant. You just, the gain from using a blockchain is not really an efficiency one, it's a censorship resistance one, or a prevention of double spends. That's what blockchains do, or that's why Bitcoin uses a blockchain. So that's the comment I would offer on that. And then lastly, we get into implications for central banks. So he mentioned that the bank has been watching this space for about 5 years. That there's no big concerns for the bank given the current low usage in Australia. And he also rightly mentions that a lot of Australians are using less cash nowadays. A lot of us do just use tap and pay, debit card, credit card, etc. So is there really a use to have a crypto, AUD or an eAUD as they say? And I would agree. I think there's not that much purpose. Ultimately, the important thing is the unit of account part. What unit do you use to measure your wealth? And with Bitcoin, it's about the different network effects that are all taking hold and taking root over time. So you've got things like so if you look up Trace Mayer's 7 network effects, I can't remember them all off the top of my head, but it's things like investment, developers, merchant adoption, merchants and exchanges, another one, and that final one is financialization, which is like, the unit, that aspect of global unit of account. Now these are sort of all taking root over time, and so our thesis is that these will continue to go that way until it does become much more dominant in terms of the global money supply. So you've got to sort of zoom out and think of it more from the unit of account point of view. And why would people want to do that? Well, they would want to hold that because Bitcoin is the strong money, it's the hard money. And so to really appreciate that, you've got to look back in history and understand what happened when societies with hard money ran into ones with easy money. And so if you look up the book The Bitcoin Standard by Safedine Moose, that is a great book. Let me see if I can find the link. Yeah, here you go. That's the one. So I've got a copy of that. It's a fantastic book. I would highly recommend you read it. it helps explain some of these concepts around stock to flow, around the history of money, around what makes a better money, and how monies can sort of compete in a sense to become the best one. So the other thing is to realize that with the EAUD or a crypto fiat or a government coin, they're not really going to offer anything new to people, because the whole point, to understand, to sort of zoom out and understand from a political point of view and from a society point of view, politicians want to get elected. They do this by promising spending. It's hard for them to tax you up front, so they look for other ways or set up a system in such other ways that enable them to still try and win votes. What's one way to do that? Well, inflation. Now, it's not some sort of deep conspiracy devious plan. It's just that everyone in the system has their own incentives and they're all set up to work that way. So politicians will try to find ways to, spend without taking the cost for that today. And if they can do that by enabling a system of currency debasement, which the RBA and other government interventions help enable, well, that's another way that politicians can try to keep power and maintain, get re-elected, basically. So what we saw is a lot of economists who basically provided what you might call the intellectual cover fire for government to take an active role in things like monetary policy, fiscal policy, so on. Those were the economists who tended to get nice positions at places like the RBA or in universities. And those economists who were saying, no, hang on, that actually doesn't make sense, that's, just logically does not make sense. It does not follow that, just by creating more money, that, the society is getting richer. Those economists weren't going to get a role at the RBA or in, these sort of fancy tenured economics professor roles at universities. So you've got to understand that point as well. It's like that saying, I think it's the, let me see if I can find it. Anyway, the point is, people have not really sort of critically assessed the system that we live under today, and we're just like fish in the water who don't really understand the water that we're swimming in. So ultimately, I would summarize the point here that I think the RBA are not seeing the disruption that's coming in terms of the unit of account, the token, the money, right? So while some of the comments were about the payment network of Bitcoin, the real disruption coming is when people choose to store their value in something other than the Australian dollar, and they choose to do things like measure their value in things other than the Australian dollar. That's really the crucial point to understand. So hopefully, that's my breakdown of this speech, and I hope that's been helpful for you guys. As always, if you found it useful, please give me a thumbs up on the video, please share the video, and please subscribe to the channel. Thanks guys, see you in the next one.